Contango can be one of the more difficult to comprehend ideas when we talk about futures markets. But it's really because it's used in different contexts all the time with slightly different meanings depending on whether you're talking about someone participating in a futures market or whether an academic is talking about it. But first, let me give you the proper definition. So the proper definition of Contango, it's actually a theory. It's actually a theory, and it really can't be. It really can't be observed. And Contango theory says that people are willing to pay more to buy some commodity in the future than the actual expected price of that commodity. So when we talk about expected price, this is a very theoretical thing. If you were to go and survey everyone participating in the futures market and say, what price do you think silver will be in 8 months? And if they all, you took your survey and they all told you the 100% honest answer, you could get this theoretical expected price. And maybe that theoretical expected price is $33. So this right here is the expected price. Expected price of silver in the market. And you can see from this futures curve right here that the silver futures contract for delivery, expected for delivery 8 months from now is trading above that. It's trading above the expected price. And it's probably trading above the expected price because people who want to have silver in 8 months, they don't want to buy it today and have to go rent some space and store the silver and have to insure the silver and worry about someone maybe stealing the silver. They'd rather just pay for a premium in order for it to have it be delivered in the future. So this is kind of the correct academic definition of contango theory, the theory that the futures price on a future delivery date is going to be higher than what the market actually expects. So people to some degree are paying a premium to have the delivery of the silver, to have it delayed. Now, in practice, you will hear people say that a market is in contango. And usually what they're talking about one of two things, and they're related. But usually if they're a little bit more correct about it, they're talking about the idea that the futures price is over time going to converge downward to the actual spot price. So what I've done here, so this is the futures curve. So this is just the price, the delivery price of the different contracts going forward in time. But this is the delivery price, the market delivery price today, right now. This is how things trend over time. So in magenta, I have the spot price trending over time, right over there. And then you can see that you have the 4-month, the contract that's for delivery in 4 months today. Its price is a little bit under $35. But as you approach its actual delivery date, so now we're actually moving forward in time, it has to converge to the spot price. Otherwise, people could make free money on that day. And so the delivery date 8 months out has to converge to the spot price eventually. And so what you see is because the spot price hasn't moved up a lot, and you see this downward converging of the different futures price, this is what people normally refer to when they say a market is in contango. When you see the delivery price of a certain futures contract converge downward to the actual spot price. All of these are converging downward over time. So it's something that you would have to observe over time, not something that you would traditionally just be able to look at a futures curve. But in general, when you have this, you normally see that the futures delivery prices are higher the further out you go. So you have this upward sloping futures curve. So the simplest kind of analysis when people say something is in contango, they'll just look at an upward sloping futures curve or a normal curve, and they'll say this is also in contango. But this isn't exactly right. It's really these movements over time. What I've drawn right here is an inverted oil futures curve. So if the futures curve looks like this, it just means that it's more expensive to buy oil today than to agree to buy oil at some future date, 2 months from now, 4 months from now, or 8 months from now. There's a couple of reasons why this might happen. The most common reason might just be there might be some type of shortage right now. For whatever reason, maybe there's a war going on, and all of a sudden we need a lot more fuel to support all of the crazy machinery and all of that. Or maybe some oil got destroyed. Maybe some oil wells are burning. Who knows? There might be some type of shortage. So people are willing to pay a premium for oil right now. The other reason why you might have an inverted oil's future curve. And this will actually gel a little bit more with kind of what we're going to talk about in this video, is that people expect the price of oil in the future to not be that different than the price of oil today. If you were to go out there and survey everyone who might be a seller or buyer of oil in the world, which is obviously not possible, but if you were to ask them, what is the expected price of oil in 8 months? They might say, hey, okay, we might even have a little shortage right now, but we expect the price of oil to be $100. And so you might say, wait, if everyone expects the price of oil to be $100, why are there some people in the futures markets today who are agreeing to sell the oil for $50? They're agreeing to sell it below the expected price. And the reason why they might be willing to, maybe they're oil producers and oil is such a volatile price, and because they are dependent on the oil revenues to support the people who live in that country or whatever else, they're essentially, in order to guarantee the price and not be susceptible to the volatility, they're willing to sell it at a discount to this theoretical expected price. So either way, this could lead to an inverted futures curve. Now, in kind of common lingo, when people see an inverted futures curve like this, they'll often use the word backwardation. Backwardation. They'll say that this futures market is in backwardation. So backwardation. And what I want to be clear is that that's what most people are talking about, inverted futures curve. But that's not exactly right if we wanted to give the precise academic definition. The precise definition is not just an inverted curve. The precise definition, and this is actually the theory of normal backwardation. It came from Keynes. And that is that the sellers are willing to sell in the future at a discount to the expected price because of the volatility, so that they can lock in their price. So the theory of normal backwardation is actually this phenomenon right here. But this is actually not observable, because you can't go and survey everyone and figure out what the actual expected price is. And you can see that they're often one and the same. The expected price was here. You had an inverted futures curve. That's why they called this curve or this market in backwardation. The one way that you can kind of observe it is if you see, so over here, this is our spot price. This is our spot price. And now we're moving over time. And you can see the spot price isn't changing much. And because it's not changing much, this cheaper futures price, as we move closer and closer to its delivery date, it has to converge with the spot price. As this one right over here, it starts at $75. As you go further and further in time, it has to converge to the spot price. And so when you see the futures price moving up towards the spot price, over as it gets closer and closer to its delivery date, that's maybe the most observable way that you could say that the market is experiencing backwardation. Let's do a quick review of contango and backwardation, because they really are opposites of each other, but they're used in different contexts, sometimes with the exact right meaning, sometimes with the not so right meaning. So let's clarify what we're talking about. So if you hear a commodities traders say that a market is in contango, they're normally just referring to the fact that you have an upward sloping futures curve. So what would technically be just, you would call it a normal futures curve because it's upward sloping, they would call it contango. It sounds a little fancier. And if you were to hear commodities traders say that a market is in backwardation, they're really just talking about an inverted futures curve. They're just talking about something like this. Now, if we were to be more precise with those, that's how it's used in kind of common everyday lingo. But if you wanted to be more precise, if someone were to tell you that, were to talk about contango theory, maybe in an academic setting, then they're talking about the notion that the future delivery price is actually higher than what people expect the price to be at that date. The problem with that is it's just a theory, and there's no way to know ahead of time what that expected price actually was. So it's very theoretical. Similarly, if someone is talking about backwardation theory, or even, I guess more particularly, if they use the word normal backwardation, if they say the theory of normal backwardation, they just don't say backwardation by itself. They say the theory of normal backwardation. They're talking about the idea that the future delivery price is lower than some expected price because the seller is willing to sell at a discount so that they can essentially lock their prices in. But once again, it's a very theoretical idea. And it's really hard to observe it in the real world because you actually don't know what the expected price is. So if someone is saying backwardation, they're usually just talking about an inverted futures curve. If someone talks about normal backwardation or the theory of normal backwardation, they're talking about the idea that the future price, the future delivery price, is below the market's expected price. I've even seen the word normal contango used when they're talking about contango theory. The idea that the future price would be above the expected price. So contango theory is the opposite of the theory of normal backwardation. Now, for both of the theories, you never know what this expected price is, so you can't literally observe it, a snapshot in real time. And the closest thing we can do to observing either a real contango in a market or real normal backwardation in a market is if, in the example of contango, if the future delivery price right now is higher than the expected, as we get closer and closer to that delivery date, it should converge or it should move down. So you can kind of observe contango over time when this price moves down as we go forward in time. This is a snapshot. This is it moving down as we move ahead in time. Same thing for normal backwardation. The only way that you can really observe it, or even attempt to observe it, is to look at what happens to this price over time. In 8 months, the delivery price is $50, but as we move forward in time, and that contract becomes closer and closer to its actual delivery date, it will converge with the spot price, and it will move up. So this observation of the futures price moving up as you get closer to delivery, that's a better way of observing that a market is experiencing normal backwardation. Hopefully that clarifies some things.